Something extraordinary is happening to the global dollar system, and most headlines are missing it. The monetary privilege that let the United States print the world's reserve currency is being quietly challenged, not with speeches, but with payment rails, commodity contracts, and bilateral trade deals. Sounds dramatic, right? But ask yourself this: if dollar dominance were truly permanent, why are central banks buying record levels of gold and building alternative settlement channels? Here's what mainstream analysis gets wrong. They treat currency power like a popularity contest, when in reality, it's an infrastructure war. Let me show you the numbers that matter. In 2001, roughly 71% of global foreign exchange reserves were held in dollars. By 2024, that number had slipped closer to 58.4%. Still dominant, yes, but the direction tells the real story. When I spoke with a regional banking consultant working on cross-border settlement systems in Asia, he told me off the record that the real shift isn't visible in reserves yet. It's visible in how trade invoices are quietly changing currency denomination. Stay with me, because what comes next changes everything. To understand whether America's currency privilege is actually ending, you need to see the three forces reshaping the system right now. First, the weaponization paradox of sanctions. Second, the rise of parallel payment architecture. Third, the commodity settlement revolution. Most people think dollar dominance rests purely on economic size, but here's what's really happening. It rests on trust, liquidity, and enforcement networks. Let's start with force number one, the sanctions paradox. The same financial dominance that gave Washington leverage may now be accelerating diversification away from the dollar. Here's what nobody tells you. When the United States froze roughly $300 billion of Russian central bank assets in 2022, the message wasn't only sent to Moscow, it was received in Riyadh, New Delhi, Brasilia, and Beijing. If reserves can be immobilized, then reserves are not neutral savings, they're conditional assets. This is the part that should surprise you. After those freezes, several emerging market finance ministries began quietly reviewing how much of their sovereign liquidity sat inside dollar-linked institutions, including settlement exposure through the Federal Reserve System and messaging dependence on SWIFT. A senior economist I met at a policy forum in Singapore described it bluntly. Sanctions don't just punish enemies, they educate neutrals. Here's what matters. Currency dominance is not lost when someone announces a rival currency. It erodes when enough participants start building insurance against the existing one. Gold purchases by central banks hit more than 1,082 tons in a single year recently, one of the highest totals ever recorded. That is not symbolism, that is balance sheet hedging. So what does this actually mean for everyday global trade? It means exporters begin inserting alternative currency clauses. It means energy contracts experiment with non-dollar settlement windows. It means regional clearing unions expand swap lines outside traditional Western liquidity channels. None of this makes dramatic television. But structurally, it's how monetary regimes shift. If you want to understand global financial power, just look at plumbing, not headlines. When I visited a trade logistics conference in Dubai, payment providers weren't debating whether the dollar would collapse tomorrow. They were discussing how to reduce single currency dependency over the next decade. That's a completely different question, and it leads to completely different behavior. The dollar system isn't collapsing overnight. That's the wrong frame. The real question is whether its automatic default status is slowly being replaced by optional usage. And once a currency becomes optional rather than automatic, the timeline of change accelerates in ways most forecasts miss. And here's the uncomfortable setup for the rest of this story. If sanctions triggered the first wave of diversification, then the second force isn't about punishment at all. It's about technology, networks, and something far more systematic than politics. Because right now, a parallel financial architecture is expanding quietly across multiple continents. And most viewers have no idea how advanced it already is. And that second system is where this global revolt really starts to become visible. In the next section, we'll break down who is building it, how fast it's scaling, and why Western analysts underestimated it. So here's the second force at work, and this one operates completely differently from sanctions. If the first wave pushed countries to question dollar dependence, the second wave is giving them the tools to actually reduce it. And the real question you should be asking is simple. What happens when global trade no longer needs a single financial highway? Most people think currency dominance is about whose economy is biggest. But here's what's really happening. It's about who owns the pipes, the switches, and the settlement clocks that move money across borders. Here's what nobody tells you. Once an alternative payment rail becomes fast enough, cheap enough, and politically safe enough, countries don't need to overthrow the dollar. They just start routing around it. Let me show you what this actually means. Cross-border transfers historically relied on a layered correspondent banking chain, often clearing through New York, even when neither trading partner was American. That automatic routing created structural demand for dollar liquidity. But over the past few years, regional systems have started linking directly. China's cross-border interbank payment system processed more than 123 trillion yuan in annual transactions recently. That number isn't symbolic. It shows scale, and scale is what turns experiments into infrastructure. When I spoke with a payments software engineer working on settlement integration for Southeast Asian banks, he explained the shift in plain terms. 10 years ago, the question was whether alternatives could exist. Today, the question is how many corridors can be connected without touching the legacy chain at all. Here's what matters. None of these systems individually replace the dollar network. That's the wrong mental model. This is the network effect paradox. One challenger fails, 10 partial challengers connect. Suddenly, users gain optionality, and optionality is what weakens monopoly power. This connects to something even bigger, and I'll show you in a minute. Because once payment routing becomes modular, trade contracts can become modular too. Energy exporters can price in one currency, hedge in another, and settle in a third. That flexibility simply didn't exist at scale 20 years ago. Think about the implications. If a Brazilian soybean exporter sells to Indonesia, financed by a Gulf bank, insured by an Asian insurer, and settled through a regional clearing hub, where exactly is the unavoidable dollar step? Increasingly, there isn't one. Not always, not everywhere, but often enough to change behavior. A senior trade economist once told me over coffee at a shipping conference that monetary transitions never start with reserve announcements. They start with invoice experimentation. By the time reserves shift, the commercial habits have already changed. Stay with me, because that insight explains why official statistics always look stable right before structural change accelerates. Here's the statistic most viewers miss. Roughly 54% of global trade invoices are still dollar-denominated, but that share is noticeably lower than the nearly 72% recorded decades earlier. This is 54, not about half. Precision matters because incremental erosion across trillions of dollars compounds into massive systemic change. If you're finding this valuable, hit that like button because the third layer of this story is where things stop looking like technical finance and start looking like geopolitical strategy. But before we move on, we need to finish the logic of this second force. Payment independence changes negotiation psychology. Once countries know they can settle outside the dominant network, even if they rarely do, their bargaining leverage changes instantly. Financial dependence used to be binary. Now it's probabilistic. And that leads directly into the next phase of the global revolt. Because technology alone doesn't dethrone a reserve currency. History shows something else always plays the decisive role: commodities. Oil, gas, metals, food, shipping lanes. The real anchor of monetary systems has never been ideology. It's been who controls the settlement terms of the physical resources the world cannot function without. And here's the uncomfortable preview. Right now, multiple major commodity exporters are quietly experimenting with non-dollar pricing structures, long-term supply contracts, and multi-currency settlement baskets. Not loudly, not dramatically, but steadily enough that if the trend continues, the third force could reshape the entire reserve system faster than most institutions are prepared for. So in the next part, we're going to follow the commodities, because that's where the monetary future stops being theoretical and starts becoming unavoidable. So let's move into the third force, because this is where the story stops being about payment software and starts being about physical survival economics. And here's the question most analysts avoid: what actually gives a currency permanent global demand? It's not GDP, it's not military alliances, it's whether the world must use that currency to buy the resources it cannot live without. For decades, the answer was simple. Energy trade anchored the dollar. After the 1970s oil arrangements tied crude exports largely to dollar settlement, every importing country needed dollar reserves just to keep the lights on. That automatic demand created what economists quietly called the energy lock effect. But here's what's really happening now. That lock is being tested. Here's what nobody tells you. Commodity pricing doesn't flip overnight. It fragments gradually through side contracts, regional agreements, and experimental settlement baskets. When I spoke with a metals procurement executive at an Asian industrial conference, he described it bluntly. We don't switch the main contract first. We test the optional clauses first. That single sentence explains more about monetary transitions than 100 policy papers. Let me show you the numbers that matter. China is the world's largest crude importer, bringing in more than 11.3 million barrels per day. It is also the largest trading partner for over 120 countries. That combination gives buyers leverage. If the biggest customer offers partial settlement in alternative currencies, exporters don't automatically refuse. They negotiate. This is the part that should terrify traditional reserve strategists. Once even 15 or 20% of major commodity flows settle outside the dominant currency, reserve managers must start holding diversified liquidity pools, not because they want to, because procurement risk forces them to. Here's the uncomfortable truth. The dollar doesn't need to lose majority share to lose structural privilege. It only needs to lose exclusivity in key resource corridors. Monetary dominance isn't binary. It's threshold-based, and thresholds can be crossed quietly. A senior sovereign wealth advisor once told me during a panel discussion that reserve strategy used to optimize for yield and safety. Now, it increasingly optimizes for sanctions resilience and trade optionality. That shift sounds technical, but it changes trillion-dollar allocation decisions. Here's what matters. Look at long-term LNG supply deals, rare earth processing agreements, and regional pipeline settlements. Increasingly, contracts include multi-currency settlement flexibility, swap-linked payment options, or pricing references tied to non-Western commodity exchanges. None of this makes viral headlines, but structurally, it reduces automatic dollar recycling into global reserves. Stay with me, because what comes next changes everything. If commodities diversify settlement, then global capital flows diversify collateral. And once collateral diversifies, sovereign debt markets start facing a completely new competitive environment. Let's be precise. Foreign official holdings of U.S. Treasury securities peaked above $7.6 trillion before fluctuating downward in subsequent years. This is $7.6 trillion, not roughly 8. Precision matters because small percentage reallocations at that scale represent hundreds of billions moving elsewhere. If you want to understand global monetary shifts, just watch what central banks do during crises. Over the past several years, gold purchases surged, bilateral currency swap agreements multiplied, and regional development banks expanded local currency lending. These aren't symbolic gestures. They're insurance policies. And here's the paradox statement most viewers miss. The stronger financial sanctions become as a geopolitical weapon, the stronger the incentive becomes for neutral countries to build systems where that weapon cannot reach them. The tool designed to enforce the system may be accelerating its diversification. This connects directly to something even bigger, because once commodities, payments, and reserves all begin drifting toward multi-currency flexibility, the entire global financial order stops being a pyramid and starts looking like a network. And that raises the final, unavoidable question. If the world is moving from a single anchor currency system toward a distributed reserve ecosystem, what does that actually mean for inflation, borrowing costs, and geopolitical power over the next decade? Because in the final part, I'm going to pull all three forces together, give this transformation a name you'll remember, and walk through the three future scenarios that could decide whether America's currency privilege fades slowly or hits a tipping point much sooner than anyone in Washington is publicly admitting. Now let me pull this together because the three forces we've walked through are not separate stories. They are one structural shift in how global money actually works. If sanctions triggered the awareness phase, payment networks created the escape routes, and commodity settlement is creating the permanent incentive to diversify. Here is what matters. The world is not staging a dramatic overnight revolt against the dollar, it is engineering a slow redundancy into the system. Stay with me because this is the part most forecasts miss. Once redundancy exists, behavior changes fast. When firms know they have two viable settlement options, they stop designing contracts around only one currency. When central banks see trade corridors functioning with mixed settlement, they stop optimizing reserves for single exposure. And when investors recognize that reserve demand may fragment, they start pricing sovereign debt differently. I heard this framed clearly by a former reserve manager who told me the shift will not look like collapse, it will look like optional plumbing quietly spreading. Let me give this transformation a name so you can track it. Call it the multipolar liquidity era, the moment when global finance stops running on automatic single currency routing and starts operating on competitive parallel channels. Here is the paradox. The United States can remain the largest economy, the deepest capital market, and still lose part of its monetary privilege. Because privilege was never only about size, it was about default status. This is the part that should surprise you. Even a 5% decline in structural global dollar demand would reshape bond auctions, currency volatility, and external financing conditions. 5% sounds small until you apply it to tens of trillions in annual trade and reserve flows. If you want to understand the future, just look at three scenarios now emerging. Scenario 1, slow adaptation. The dollar remains dominant, but operates inside a basket world where maybe 60% of reserves stay dollar-based while regional systems handle the rest. Borrowing costs rise modestly, but stability holds. Scenario 2, competitive blocks. The world divides into overlapping financial zones. North America, Europe, and aligned partners keep dense dollar liquidity, while Asian and commodity corridors expand mixed settlement structures. Volatility increases, and countries must actively manage currency exposure. Scenario 3, acceleration. A geopolitical shock forces multiple major exporters to mandate diversified settlement for strategic resources at the same time. Central banks respond by sharply increasing gold and non-dollar reserves. Global funding markets reprice quickly and borrowing costs jump across heavily indebted economies. Here is what matters. None of these futures require a dramatic announcement. They only require enough participants deciding that flexibility is safer than dependence. If you are still watching, you already understand something most headlines miss. Monetary power does not vanish, it diffuses. And once diffusion starts, it rarely reverses. So here is my question for you, and I genuinely want to hear your take. Do you think the next global crisis will strengthen the single reserve system or push more countries into the multipolar liquidity era? If this breakdown helped you see the system differently, subscribe for more deep dives like this and drop your answer in the comments, because the smartest insights often come from the discussion itself, and the next shift we analyze may arrive faster than anyone expects in the coming decade as trade alliances, technology standards, digital settlement platforms, energy transitions, shipping insurance, and sovereign strategy all keep quietly rewriting the rules of global money, power, and financial influence across every major region on Earth. Much sooner than most investors, bankers, officials, or voters currently imagine happening beneath the surface of everyday transactions. The reality is that systemic monetary change usually feels boring, technical, incremental, and easy to ignore until suddenly liquidity shortages, pricing shocks, and political disputes make the underlying architecture impossible to overlook. And by then, governments, corporations, banks, and households must adjust in real time to a financial landscape that no longer behaves the way textbooks predicted or policymakers promised or markets assumed stability guaranteed yesterday, and that is exactly why understanding these three forces today may be the single most important advantage any serious global investor, policymaker, business leader can